Hello, and welcome back to another series of lecture videos, or demonstration videos rather. And in this set of videos, we're going to be looking at Chapter 1. And Chapter 1 deals with the equity method of recording investments. Now, this is a topic that has been addressed in Intermediate 1 and I believe Intermediate 2 as well. So what we're going to do here is kind of dig a little deeper into the equity method. How do we record things, or how do we record investments in other companies utilizing that equity method, and specifically, when do we use the equity method? Well, if you remember back to intermediate accounting, we said that we use the equity method whenever a company invests in the equity stock of another company and they purchase anywhere between 20 to 50% of the outstanding stock. Well, after reading this chapter, hopefully you discovered that, that 20-50 rule is kind of arbitrary in a sense, right? Basically, what we need to look at is, does the company, meaning the investor company, do they exhibit or do they gain significant influence or control over a company? So regardless of the amount of outstanding stock that's purchased, whether it's between 20 and 50%, specifically though, if the company has significant influence or control, which quite possibly could exist with less than 50% of the stock, or having less than that 20 to 50% of the outstanding stock. So what I like to do is look at learning objective number 4, which deals with describe the financial reporting for equity investments and prepare the basic equity method journal entries for an investor. Now, in order to do that, we're going to look at problem number 6. So if I were you, I would have my book open to problem number 6, and we're going to go through it. Now, before we dive in, it's important to know, what are the rules? When do we apply the equity method? Well, the accounting objective of utilizing that equity method is to report the investment and investment income to reflect that close relationship between the investor and the investee. So under the equity method of reporting, we have 2 rules. Number 1, investors or the investor's investment account will increase by the percentage of ownership interest as the investee recognizes and reports income. What in the world does that mean? Well, what that means is the investor is going to report in their financial statements, in their books, their portion of the investee's net income. Okay. The second item under the equity method of reporting says that the investor decreases its investment account for its share of the investee's cash dividend. So anytime a investee company reports cash dividends, that investor company is going to decrease the investment account on its books. Okay, so let's go ahead and let's look at number 6 here. Problem number 6, excuse me. Now I have the electronic book, so the page number might be slightly different than your book. But problem number 7 looks like it's on page 29, at least for the electronic book. Okay? So what's going on here? Well, on January 1st, Belleville Company paid $2,295,000 to acquire 90,000 shares of O'Fallon's voting common stock, which represents a 30% investment. So right off the bat, 30% investment, hey, that fits that range that we should utilize the equity method, right? They go on to tell us that no allocation to goodwill or other specific accounts are made. Okay. Significant influence over O'Fallon is achieved by this acquisition. So Right there, they're telling us that, hey, you know what? Belleville has controlling interests over O'Fallon. Got to use the equity method. Okay. They say that O'Fallon declared a $1 per share dividend during the year and reported net income of $750,000. We have to determine what is the balance of the investment in O'Fallon's account found in Bellevue's financial records as of December 31st. So to make this easier, first thing we're going to do is create a T account. Why? Because T accounts are sexy. Well, they are, but more importantly, it is a great visual representation of calculating a specific balance in an account. Okay, so we're going to take our investment account, specifically investments in O'Fallon. Okay. There we go. Okay. So the first thing we do, they tell us on January 1 is we buy 90,000 shares. Okay. So what's going to happen? Well, our investment account is going to increase by $2,295,000. Okay. Now the journal entry, what does this look like? Well, the journal entry to record, bear with me here. Okay. So the journal entry to record, we're going to debit investments in O'Fallon for $2,295,000. We're also going to credit cash for the same amount. We're assuming they paid cash for this. Okay, so that's the first journal entry, and notice how it impacted the investment in O'Fallon account. It increased it by basically $2.3 million. Okay, now the next thing we need to do is we need to calculate what is the net income, or more specifically, what is the Belleville's portion of O'Fallon's net income. Well, they tell us in the problem in the year O'Fallon reported net income of $750,000. Okay. Well, remember, Bellevue's investment is 30%, right? We own 30% of Fallon's outstanding stock. That means that we're entitled to 30% of O'Fallon's net income, right? Why? Well, because remember, what we're trying to do here, the objective of this equity method is to report the investment and the investment income to reflect that close relationship. Since we have a close relationship here, and because the rules state, hey, we have to increase the investment account by our percentage of ownership interest when the investee recognizes and reports net income. Okay, that's what we're doing here. So I'm going to multiply that by the 0.3 or 30%. We see that we get $225,000. Okay, now this is the net income. So that means that that's going to increase our investment in O'Fallon. But before we go to the T account, let's look at that journal entry. What does that journal entry look like? Well, we're going to debit investment in O'Fallon for the amount of $225,000. And we're going to credit an equity account. Specifically, we're going to say equity and investee income. Okay, and that's going to get credited for $225,000. So now we can post this, right? This journal entry that we just did, we can post it to the ledger or our T account, and we could see that our the amount that we're recording, or the amount that we're reporting for Fallon, is increasing by that amount of net income. Okay. Now, the next thing they tell us is that they declare a dividend. Specifically, they declare a dollar dividend, right? Well, we have 90,000 shares. Okay. They declare a $1 dividend per share. So we end up seeing that when we run the numbers, our dividend that we are entitled to is $90,000. Well, is it 90,000? Let's think about that for a minute. Okay? Let's think about that. Is it 90,000 or should it be 30% of the 90,000? Well, the answer is no, it's 90,000. Why? Well, because think about it. What are we reporting here? Well, we're reporting that we have 90,000 shares and we're getting $1 per share. That's $90,000. Okay? If by chance they said that, hey, the total dividend that they declared and paid was $1 million, that means that everybody that owns shares, right, got a dividend, and that total dividend equaled out to be $1 million for everybody. Okay? In that case, we would take 30% of the dividend. But because they specified the number of shares that we actually hold, that's the amount of our dividend, right? So what we're going to do here is we're going to say, okay, let's do our journal entry, right? Because remember, we've got to do the journal entries, then we got to post, right? By posting the dividends, what are we doing? Well, we as the investor are decreasing our investment account for the share of the investee's cash dividend. So, first thing I'm going to do is I'm going to debit dividend receivable for 90,000, and I'm going to credit investment in O'Fallon for 90,000. Okay? So, what we're going to do is we're going to post this dividend payment or declaration of a dividend for 90,000. Remember, whenever the investee reports a dividend, the investor has to decrease on their books that investment in that investee. Okay? So this is the dividend. Oh, didn't want to do that. Bear with me here, sorry. Don't know why that did that. Okay, so what I'm doing now is just calculating the balance of the investment in O'Fallon account. Well, originally when we bought the stock, the account went up by $2.295 million. O'Fallon O'Fallon reported net income of $750,000. Well, of that 30% is going to, or of that total amount, 30% of that comes to us. So we're going to increase our investment in that account. Then we're going to subtract out the dividends. We end up with $2.43 million. So in that case, the answer is B, $2,430,000. Okay? So hopefully this was a good review of how you calculate or how you utilize the equity method. Okay? When we come back in our next video, we're going to look at learning objective 5. How do we allocate the cost of an equity method investment and compute amortization expense to match revenues recognized from the investment to the excess of investor cost? Okay, so we'll look at what's the difference between what we pay for it versus the book value, and what happens if we pay more than the book value of the company. So we'll look at that in our next video. So thanks for tuning in, and we'll see you in our next video.